Hi there. Worried about inheritance tax on your investments? In 2 minutes, you'll know if AM shares still work as a shelter.
Welcome to The Explainer. Right, today we're tackling a massive multi-million-pound question. AIM shares and inheritance tax after April 2026. Still a good shelter in the UK? We are unpacking a seismic shift in UK tax law that is, quite frankly, about to catch thousands of families completely off guard. If you've been building your wealth, planning for your family's future, or investing heavily in the UK markets, the rules of the game are fundamentally changing. We're talking about sweeping, historic reforms to inheritance tax and business property relief that will hit in April 2026. For decades, investors have relied on certain established rules to protect their life's work. Well, almost overnight, the foundation of that entire planning strategy has been completely rewritten.
To really grasp the scale of this, I want you to imagine a shocking but entirely real-life scenario. Picture a hard-working UK entrepreneur. For years, they've diligently built up an alternative investment market, or AIM, ISA portfolio. Now, they didn't do this by accident. They did it specifically because previous governments practically begged them to, offering massive tax incentives to stimulate investment in smaller UK companies. Through sheer discipline, they grew that portfolio to £1 million. It was their pride and joy, their legacy. Under the old rules, they slept soundly knowing that entire £1 million could be passed down to their kids, completely tax-free. But, as of April 2026, that exact same portfolio, held by the exact same person, will trigger a sudden, mandatory £200,000 tax trap upon their passing. That is a devastating, unexpected blow, wiping out years of growth with a single stroke of the Chancellor's pen.
And that is exactly why we're having this conversation today. I want to introduce you to My Tax Accountant, or MTA. They are a UK accounting firm and your expert step-by-step guides to navigating UK tax compliance safely. Look, the tax landscape right now can be an absolute minefield. But MTA doesn't just crunch numbers in a back room. They look at your entire family's financial ecosystem. They truly understand that behind every tax code is a family's future. With the right proactive guidance from the experts at MTA, you can solve these incredibly complex problems, pivot your strategy, and keep your family's hard-earned legacy entirely intact.
Okay, let's dive into this. Here's our roadmap for today's explainer. First, the 2026 AIM tax trap. Second, how AIM rules are changing. Third, calculating your new tax bill. Fourth, everyday taxpayer impact. Fifth, strategic alternatives. And finally, next steps with MTA. Section 1, the 2026 AIM tax trap.
For ages, the alternative investment market was the absolute go-to shelter for inheritance tax planning. The deal was beautifully simple. If you held qualifying AIM shares for just 2 years, you received 100% business property relief. That meant zero inheritance tax. It was a brilliant way to keep capital flowing into growing UK businesses. But the era of unlimited tax-free wealth transfer via AIM shares is officially over. From the 6th of April 2026, the relief on AIM shares is being slashed from 100% down to 50%. Government budgets change with the wind, and this time, investors are caught right in the storm. This brutal downgrade creates an effective tax rate of 20% on your AIM holdings. A shelter that once offered complete immunity now has a massive leak in its roof.
Now, what's really interesting here is this. Did you know that AIM shares do not count toward the new £2.5 million 100% business property relief allowance? This is a massive trap for the unwary. The government did introduce a new capped allowance where the first £2.5 million of certain business and agricultural assets still get 100% relief. Many investors heard that headline and thought, great, my AIM portfolio is safe as long as it's under $2.5 million. But the fine print reveals that AIM shares are treated as a completely separate, inferior category now. Whether you have £10,000 or £10 million in AIM, it is all subject to that 50% relief cut right from the very first pound. There's literally no safe harbor allowance for AIM anymore.
Section 2, calculating your new tax bill. Let's actually run the maths on this, step by step, taking a moment to deeply understand how this 40% cut actually feels when applied to your wealth. Step 1. Imagine you have that £1 million AIM portfolio we talked about, held patiently for over 2 years.
Step 2. Under the new rules, we apply the 50% relief. That means £500,000 is protected and passes down safely. Great. But the remaining £500,000 is suddenly dragged directly into your taxable estate. Step 3. HMRC taxes that remaining half at the standard, punishing inheritance tax rate of 40%. Just think about that for a second. HMRC is essentially taking 20% of the total value of an asset you bought specifically because it was supposed to be tax-free. The result is a staggering £200,000 inheritance tax bill. That isn't just a rounding error. For many families, that is life-changing money redirected straight to the Treasury.
Section 3. Impact on everyday taxpayers.
We really need to look at these everyday scenarios because the collateral damage of this tax trap is enormous. It goes way beyond the ultra-wealthy. Let's start with property owners. Imagine a family whose estate consists of a nice family home in the southeast, maybe worth £800,000, alongside an AIM portfolio they built for legacy planning. When that new AIM tax bill hits, the estate might be completely cash poor. The children could literally be forced to sell the family home, the house they grew up in, just to generate the cash to pay HMRC for the AIM shares. What about freelancers? Picture a 55-year-old graphic designer who never had a corporate pension. They put every spare penny into an AIM ISA because it was pitched as the ultimate retirement vehicle. Tax-free growth, tax-free income, and tax-free upon death. Well, now their primary safety net is fractured and their retirement math needs a total redo. Then we have long-term employees. They might not even own AIM shares, but they're hit by a compounding problem. Unspent pensions are entering the inheritance tax net in 2027. If an employee dies with a large unspent pension, it pushes their entire estate value up, potentially dragging other assets into that 40% bracket. And finally, small business owners. The local manufacturer who spent 30 years building a company must now meticulously navigate how their private company's shares interact with the new £2.5 million cap, ensuring they don't accidentally breach it and trigger a massive tax event. Every single one of these people thought they were playing by the rules, and now the rules have changed.
Before we get entirely bogged down in the doom and gloom, here is a brilliant professional tip. While AIM is explicitly excluded, that new £2.5 million allowance for private, unquoted businesses and agricultural property is entirely transferable between spouses and civil partners. That means with proper, meticulous planning, a married couple can combine their allowances. They can shelter up to £5 million in qualifying non-AIM assets completely tax-free. This is a massive lifeline. But, and this is a big but, it doesn't happen automatically. It requires strategic structuring to ensure the assets are held correctly, which is exactly the kind of administrative heavy lifting that MTA helps clients navigate.
Section 4. Strategic steps to take now.
And this brilliantly illustrates our options moving forward. The big question is AIM still a good shelter? To answer that, we have to look at the strategic alternatives. First, we have the new reality of AIM shares. They carry a 20% effective tax rate on death. They are highly liquid, you can buy and sell them easily, but they carry medium to high market risk because these are smaller publicly traded companies subject to the market's mood swings. In the middle, we have EIS, or Enterprise Investment Scheme investments. These are fascinating because they miraculously retain their 0% inheritance tax status, and they even offer upfront income tax relief. However, understand the trade-off here. They are highly illiquid. Your money is locked up for years, and they carry very high risk because you're investing in early-stage startups. On the far right, we have non-AIM asset-backed investments. Think of physical, tangible assets, private infrastructure, renewable energy projects like wind farms, or secured property lending. Because these are unquoted private businesses, they can qualify for the £2.5 million allowance, meaning 0% tax. Plus, because they are backed by physical assets, they offer much greater stability and a lower correlation to the wild swings of the stock market. For many looking to preserve wealth rather than aggressively grow it, this asset-backed route is quickly becoming the preferred harbor.
Now let's talk timelines, because the clock is absolutely ticking here. The tension is building and the schedule leaves very little room for procrastination. The reforms were announced back in October 2024. The absolute cliff edge is April 2026, when the AIM 50% relief cut officially becomes the law of the land. But the danger doesn't stop there, does it? April 2027 brings the second wave. Unspent pension pots will be dragged into the inheritance tax net. This creates a compounding danger for your estate, a total double whammy of taxation that drastically shrinks the avenues for tax-free wealth transfer. Waiting until 2026 to review your portfolio isn't just risky, it's financially reckless.
This brings us to a frankly terrifying concept in estate planning, the dry tax crisis. A dry tax happens when your estate owes a massive tax bill to HMRC but doesn't have the actual cash on hand to pay it. You can't pay the taxman with shares, right? You have to pay with pound sterling. Pre-2026, a £5 million AIM estate had a £0 liquidity need for taxes. It was perfectly balanced. Post-2026, that exact same estate suddenly generates a £1 million tax bill out of thin air. If your grieving executors don't have £1 million in cash just sitting in a current account, they face a nightmare. They will be forced to fire sale those AIM shares simply to meet an HMRC deadline. If the market happens to be crashing that month, they might have to sell £2 million worth of value just to clear the £1 million tax bill, utterly destroying the wealth you spent a lifetime building.
Section 5. Next steps with MTA.
Let's quickly wrap up our core takeaways from today's explainer, keeping in mind exactly why this matters to you. Number 1. AIM shares are no longer the magic bullet. They are now effectively taxed at 20%, eroding your legacy. Number 2. AIM is explicitly excluded from the new £2.5 million protection allowance, so you cannot hide behind that cap. Number 3. Alternative 100% relief options do still exist, like IES and private business property relief, but they absolutely require a sophisticated understanding of liquidity and risk. And finally, an immediate portfolio review is essential. The clock is ticking toward April 2026, and inaction is literally the most expensive choice you can make.
So I want to leave you with this deeply provocative question regarding your current strategy. Is the 20% tax buffer of AIM still worth the market volatility and risk for your family's legacy? When it was completely tax-free, the market risk made sense. But now that HMRC is taking a 20% cut regardless, the maths for many families simply no longer stacks up. You need professional intervention to ensure your life's work isn't eroded by preventable, deeply frustrating taxes.
Of course, a quick disclaimer before we wrap up. Investments qualifying for business relief are high risk, and your capital is at risk. Tax rules are highly complex, subject to change, and depend entirely on your individual circumstances. The information provided in this explainer is strictly for educational purposes and does not constitute financial or investment advice.
Don't let the April 2026 deadline catch your family off guard. Reach out to the experts at My Tax Accountant today for a comprehensive personalized consultation. Give them a call directly at 0208-570-8531. You can drop them an email at info@mytaxaccountant.co.uk or visit their website at www.mytaxaccountant.co.uk to learn more about how they can protect your estate. And to stay updated on all the latest tax changes and strategies, make sure to subscribe to the MTA YouTube channel. I'll leave you with this final thought. The rules of wealth transfer in the UK have fundamentally been rewritten. Will your family be the ones paying for the new budget or the ones who planned ahead? Thank you so much for joining us, and we will see you next time.